Good afternoon and welcome to this SW Financial Reporting webinar series, wherever you might be joining us from today. I'm Renee Muller. I'm a partner with SW and I will be moderating today's session. It's great to have so many of you here with us today on the line. Firstly, I acknowledge the traditional custodians throughout Australia and their connection to land, sea and community, and we pay our respect to the elders past, present and emerging. Our presenters today are from across the SW National Practice. I will provide an update today on some ASIC information, corporate governance and some other regulatory changes. Jimmy Chow will be talking through some accounting standard changes today. And Brent Shears will join us to provide some insights on the key focus areas for 30 June 2022 reporting. Before we start, I would like to run through a little bit of housekeeping. We recommend that you click on the Enter Full Screen button at the top right-hand corner to achieve the best webinar experience. If you click the Q&A button at the bottom of your screen, a window will pop up that will allow you to send us questions as we go. We will monitor these and answer any that we can during the presentations, but some we will save for the Q&A at the end of the session. For more bespoke questions, we may need to connect with you after the session today. We will circulate the slides today after the webinar to anyone who registered for today's session. So before we kick off, we are running a live poll today. The poll question will appear on your screen now, magically, and it can be accessed at any time using the poll button at the bottom of your screen. Once you answer the question, it will disappear, and we'll share the results with you later in today's session. I'll just give you a few seconds to answer that poll and then we'll get started. So the first session today is an ASIC update from myself, corporate governance update, some other regulatory changes. Like I said, we'll then go to Jimmy for accounting standard changes, and then we'll go through the key focus areas for 30 June reporting. Okay, here we go. So first thing I wanted to talk to you about today is the financial reporting update for AFSL holders. So I know this only applies to a small number of people on the line today, those with AFSLs, but it is quite a hot topic. So the press release on this came out finally after a long awaited from all of us to hear from ASIC on it on Friday, just gone, so less than a week old. This is applicable from 1 July 2021, so they waited right till the end before they issued their media release on this. And basically what the media release from ASIC said is AFSL holders will need to prepare financial statements with disclosures in accordance with accounting standards as issued by the ASIC. Now, I wanted to just quickly give you an insight into what's the difference between a Chapter 2M set of accounts and a Chapter 7 set of accounts. So when we talk about Chapter 2M and Chapter 7, we're talking about a subsection of the Corporations Act. A Chapter 2M set of accounts refers to a large company in Australia preparing financial statements under the Corporations Act. Chapter 7 is specifically financial statements prepared by AFSL holders in Australia. So Chapter 2M, generally what is disclosed in a Chapter 2M set of accounts is governed by the Accounting Standards of Australia, so the ASIC issued standards, whereas Chapter 7 accounts and for AFSL holders is determined by ASIC, the corporate regulator. So ASIC's media release here only refers to Chapter 7 entities, but some AFSL holders will also be large entities, so they will be Chapter 7 and Chapter 2M, and that's where it gets a little bit complicated. So basically what ASIC is saying is an AFSL holder can no longer prepare special purpose financial statements. Now this is not too surprising because the accounting standards in Australia removed special purpose financial reporting a couple of years ago. It's only becoming mandatory for 30 June 2022 though, but AFSL holders have been unsure if they're only reporting under Chapter 7, what they're going to have to do. So no longer special purpose. So the question is, do you do Tier 1 or do you do Tier 2 general purpose accounts? Tier 1 being full, similar to a listed company, and Tier 2 being simplified disclosures, so less disclosures. Now, ASIC has said, if an AFSL entity has public accountability, it is required to do full Tier 1 general purpose accounts. So then the question becomes, what does public accountability mean? So if an entity, an AFSL holder, has debt or equity that's traded publicly, it's got public accountability and it needs to do tier 1 accounts, or if it holds clients' monies, hold assets in a fiduciary capacity, then it needs to do full tier 1 accounts. Now this we had expected because ASIC told us this informally for the last 12 months is probably going to be what tier 1 accounting is going to look like for AFSL holders. But then surprisingly, ASIC came out and gave us this long list of other entities who, for the avoidance of doubt of whether they do have public accountability, should be preparing tier 1 accounts. Now this was probably the first surprise, I think, in the media release. So if you're an AFSL entity that falls into any of these categories, there will be a requirement to do full tier 1 general purpose accounts. I'm not going to read them for you, but we will send the slides afterwards, so you'll have the list there. They then also just said, oh, by the way, all AFSL holders must prepare a cash flow statement. And if you have controlled entities, you do need to prepare consolidated accounts. That's not too surprising because that is what general purpose accounts typically would contain. But then the second surprise in the media release was that ASIC said some entities can defer the application of general purpose accounts for 12 months, so until 30 June 2023, if you've previously lodged special purpose accounts and if you don't prepare accounts under Chapter 2M. So if you're not a large company that also have to lodge accounts under Chapter 2M, you can actually defer this for 12 months. Now, this is the gift from ASIC, unusual, for a lot of small AFSL holders. And I think a lot of entities will be quite happy to know that they've got this because it'll save them some cost and it'll basically kick the problem down the road. However, I do think it is important to stop and consult with your stakeholders before just deciding to kick the ball down the road, because some lenders, investors, other stakeholders might actually expect your entity to prepare general purpose accounts. And if you don't, there might be some questions around, the compliance of the financial statement. So definitely, I'd say consult with stakeholders first before deferring application of general purpose accounts if you're a small AFSL holder. Now, there will be transitional relief whereby the new disclosures will not be required for the comparative year. So anything you didn't disclose last year, you don't need to disclose for your comparative numbers this year. And we're also expecting an amended FS70 form in late June. So we'll see what that says. The second thing I wanted to run through today is a new entity type called corporate collective investment vehicles. Now, this is a new legislation that forms part of the Corporations Act from 1 July 2022, so in around 3 weeks' time. It's a new type of entity and is specifically designed for funds management, the purpose being to attract more foreign investment into Australia. So a CCIV entity will more closely align to similar type of entities in other jurisdictions. So it'll be better understood by offshore investors and fund managers. It'll operate similar to a company limited by shares, and it'll have many features similar to registered schemes, such as needing a compliance plan. A CCIV entity will have a sole corporate director. That's a public company with an AFSL. And there's a specific tax framework for CCIVs. Can be retail or wholesale, and there will be a requirement to prepare financial statements for all sub-funds in a CCIV group. The audit requirements will be limited to retail CCIV entities, and compliance plan audits will be required. The next thing I just wanted to highlight is that ASIC did release a few months ago, I think maybe in November or so, maybe October, some guidance on crypto assets related investment products. I'm not going to give you too much information on it because it's probably not relevant to that many companies. But what I found interesting about this guide is, first of all, it's actually quite an interesting read. It's not as boring as you'd expect. It's quite a nice guide to read. So I would say if you're interested in this area, go have a look, go read it, because it is quite interesting to read. But what it shows is that ASIC is starting to embrace crypto assets as something that's here to stay, and that they probably, well, definitely will need to regulate as part of being the Australian regulator of these kind of products. And so it is quite interesting to see this as a kind of a starting point of ASIC starting to get involved in regulating crypto assets related products. Director identification numbers. Now, this isn't brand new. This has been out there for a while, but what's new, well, what's kind of progressed this time is that existing directors could have, or you could have appointed before April this year, you could have appointed a director and then get an ID number. But from April this year, you now need to make sure anyone you appoint to your company already has a director ID before you appoint them. So the purpose of these is to stop illegal phoenixing activities and to increase accountability and traceability of directors. So in a nutshell, anyone who's a director of a company in Australia needs to register via the ABRS for a director identification number. There will be significant penalties for a director that's appointed to a company that does not hold a valid director ID. Another thing that's new this year is for any fund that complies with the SIV framework, so SIV being Significant Investor Visa Scheme, from 1 July 2021, there's been quite a few changes come through to what the framework looks like. So some of the changes include the range of visas that's required to maintain complying investments has increased. So there's different types of visas that now also need complying investments. There's been a reduction of some of the investment periods, some changes to investment allocations, so what you can invest in and still qualify for a CIV visa. But also, and this is where I come in as an auditor, there's new audit requirements applicable to CIV compliant funds. So a fund that holds itself out to be CIV compliant will need to get an annual audit of their compliance. So not the financial statement audit, but the compliance audit of whether the fund does indeed comply with the investment framework. So anyone who lodges a CIV visa application will need to attach the audit report of the funds that they've invested their monies in. And the audit report will be to confirm the emerging company's investment and the balancing investment components of the complying investments framework does indeed comply. So that's the new audit requirement there. And the last thing I wanted to run through with you today is a couple of standards that's been issued by the International Sustainability Standards Board. Now, these are two new standards that were issued in March, only a couple of months ago. They're still in exposure draft format, so they're not actual standards yet, so EDs. One is on general sustainability related disclosures, and the other one is looking at specific climate related disclosures. So the general one, the exposure draft is open for comment until the 29th of July. So if you're really interested in this area, I do recommend reading it, and maybe if you want to submit some thoughts, some comments to them, go for it. The really interesting thing that I want to point out with this is the objective and the scope. So the objective of this first one is to disclose information about sustainability related risks and opportunities so that users can assess enterprise value and decide whether to provide resources to the entity. And the scope is probably for me the more important one, or the more interesting one. What they're saying in the ED is an entity may apply these standards when preparing financial statements in accordance with IFRS or other GAAP. So basically, these standards are not being mandated at this stage. So it's standards for any entity to choose to apply. So what they've done is they've left it open for different jurisdictions, different countries, different regulators to decide for themselves whether or not to mandate it. IFRS for now is not mandating or not proposing to mandate the application of these standards once they're final, which I found quite interesting and probably appropriate at this stage, I think, given this is brand new. So the standard is split into 4 sections: objective, scope, core content, and general features. I didn't make this up. This is how they've structured their own standard. And this is just kind of the content that it covers. So if you want to learn more about it, I recommend go and read it. It is quite interesting as a new type of standard. And the second one on climate related disclosures, again, it's a may apply these standards when preparing accounts, so it's not being mandated. But the objective for this one is to disclose information about climate related risks for users to understand the enterprise value, the entity's use of resources, and the entity's ability to adapt. And the categories covered by this standard is objective and scope, governance, strategy, risk management, metrics, and targets. And that's how they've laid the standard out. So it is quite interesting as a read, and I would recommend having a look at it if you're interested in this area. And that's it for me on the governance update. I'm going to hand over to Jimmy to go through some accounting standard changes for this year.
Thanks, Renee. Now I'm going to just talk to you about what are some of the changes to the accounting standard. So just a very quick one. That's not a lot, or not a lot of big ones happening. So let's first look at what are some of the accounting standards that's going to be effective for the first time for June year-end entities. So I list quite a few, but I don't think a lot of this will be widely applicable to most of the entities. So the first one is if you having a LIBOR instrument, so you're probably aware the LIBOR is going to be no longer exist. So this accounting standards basically address what to do with your current debt that's denominating LIBOR once it's transit into another instrument. What do you account for it? So if you have a LIBOR denominated borrowings, you want to look into this standard. So it's going to be effective for the first time for this June period. And then next, we are going to have a new insurance contract accounting standard. So this is not the standard itself. So this one I listed, ASB 2020-5, is basically say the insurance standard is going to push out the effective date for another year. The next one, we have the COVID-19 related rent relief. So we all know during the pandemic, that's a lot of the lease, you will get some rental concession, rent relief from the landlord. And how do you account for it is the accounting standard. The specific newly crafted accounting standard give you a choice to bring that relief straight into the P&L rather than going through the whole changes to the lease modification, which is very difficult to do. So this standard is going to be applicable still for June 2022, but after that, that's no longer an option. So the next block that I highlight is to do with removal of special purpose and moving into the general purpose. So this has been there for a few years. People are aware of these changes. This is going to be the largest changes in accounting world, in Australia accounting world for many years. So just give you a very high level recap what's going to happen. So from this year, the June 2022, for certain entities, the options of producing a set of special purpose financial statement is no longer there for certain entities. So just talk a little bit detail, what are the entities that's going to be affected by these changes. So first camp is if you have a legislative requirement. So if you are required by law to produce a set of financial statement in accordance with Australia accounting standard. So as Renee mentioned previously, if you are doing corporations Chapter 2M, if you are large proprietary companies, or if you are foreign-owned subsidiaries of, you will then require to produce a set of general purpose accounts. And Renee did talk to you about AFSL requirements. So if you are AFSL holders, do look into that. There's slight nuance and difference if you are holding an AFSL license. So this is the first camp. If you are required by law, you will have to do general purpose accounts. Or if you are required by a document, so a document can be a constitution document, that's your trustee partnership agreement, or other documents that can be a loan agreement. So if this document say you need to prepare a set of accounts based on Australia accounting standard, and I do put emphasis here, this is the name that we want to protect. If you are required by a document, to produce a set of accounts based on Australia accounting standard. And this document is created or amended after 1st July. So they do know this is kind of a big ask, and they give you this grandfathering. If that happens, you are required to do a set of general purpose financial statement. So we do have a webinar, 1-hour webinar, talk about these topics in a great amount of detail. So we will include a link in the handout that we're going to send out after the webinar today. So when company move from a set of special purpose to a general purpose, there's quite a fair bit of requirement. So together with the requirement to prepare general purpose, the Australia Accounting Standard Board does give a new disclosure framework. So it's called Simplified Disclosure. So it's ASB 1060. So the simplified disclosure basically governs a lot of the tier 2 entities. So what's the difference between a special purpose and a simplified disclosure? So I list a few key items we think it's going to be applicable to most of the entity who's moving from special purpose to general purpose. So the first one I list here is on revenue. So under the new simplified disclosure, you will give away quite a lot of details about revenue. So you will need to have breakdown of different revenue stream, breakdown of the recognition point of different revenue, whether it's point in time or it's over time. It's basically, you do need to tell a story in your revenue notes for the user to be understanding the business of the entity. So the next big one is going to be tax. So typically, if you look at the special purpose accounts, that's not a great amount of information giving away in relation to taxations. But if you are doing a set of simplified disclosure financial statement, there is quite descriptive requirements for you to disclose your tax information. So one is to disclose the reconciliations of your effective tax rate. So it starts with profit before tax times 30% or whatever percentage of tax the company is applicable. And then you need to plus minus what are some of the reconciliation items that could be expenses not deductible for tax purpose, or certain income is you don't have to pay tax for it, and then get to your ending tax position informations. So that's going to be something new if you are doing a set of general purpose financial statement. And also there will be quite a lot of information required in terms of this, deferred tax balances and reconciliations. Related party disclosure is another big one. You are not required to present those informations in special purpose, but now you have to say who is your related party, who is your immediate ultimate parent company, what are some of your transactions dealing with them. That's quite a lot of work if you are someone have quite a lot of related party transactions. And also just in general, in terms of financial statement disclosure, there's a lot of movement and reconciliations required for the disclosure. That can be a property, plant, equipment moving from beginning of the year to the end of the year, or provisions. So comparative information is required. If now you're producing your June 2020 accounts, you do have to go back to 1 year to pull out all the informations for June 21. So that's if you are not early adopt, and then the early adoption window has closed. And also for those entity who is on general purpose framework already, and if you are doing reduced disclosure, so if you remember for those significant global entities a few years ago, they have moved into the general purpose accounts reduced disclosure. So the reduced disclosure regime is officially withdrawn. So it's going to be replaced with the new simplified disclosure. So now we have a look at what's going to be effective for the first time for June 21 entities, let's look a bit down the road, what are some of the new accounting standards coming through. And also just a reminder, if you are a December year-end entities, your application days will be different. So some of the standard at least here will be applicable to you for the first time for current year. So the first three items, I'm going to talk a little bit more details. Then the insurance contract, the new standards, is going to be first time effective for 1st January 2023. If you're an insurance company, I'm sure you're already all over it. The next one is there's a new changes to clarify how do you account for deferred tax when you have a transaction that doesn't affect P&L. So you think your make good provisions, when you first booking your make good provision, you will debit your assets, credit your provision liability, so it doesn't affect your P&L. So the new standard basically say you will need to do tax effective on those transactions as well. So let's jump into some of the standard in a little bit more detail. The first one I want to call out is the annual improvement. So an annual improvement is basically a accounting standard that's the changes to the accounting standard that's not big enough to make it stand alone. So they bundle those things together, and most of those is to address some inconsistency. Some of those are editorials in terms of the wordings, but I do find in this particular annual improvement, annual amendment, there's two interesting ones. They may not affect all the entities, but if you are one of the entity that's the standard that's applicable to you, it may have a huge impact. So the first one amendment is to do with property plant equipment. So what it does say is if you are preparing your assets to be ready to use, so think about if you are a mining company, you are putting in all the machinery to make sure you are ready to make productions. So sometimes you will have some bypass product coming out from this process, and we obviously sell those products and get the money. And how do you account for the proceeds you get when you have this type of transactions? So in the old standard, it actually say, okay, you go net off your proceeds against your property plant equipment. So moving forward, you have a smaller depreciation charge into your P&L. And after the amendment, it actually require you to bring the proceeds into your P&L. So it booked as your revenue when you sold it. So one thing's worth mentioning is you also need to account for your cost of sales as well. So that's involve your standard costing, or sometimes people will need to adjust what are the level of overhead being charged because the assets is still under preparations. So if you are a extractive, if you're in extractive industry, if a mining company or a gas company, this particular amendment may have impact on you significantly. And the next one is to do with a provision for a loss-making contract. So the accounting standard require you to recognize the foreseeable losses if you have a loss-making contract when you identify that. So you book your P&L and they create a provisions. So this particular amendment basically say when you are assessing whether a contract is loss-making or not, you need to include all the incremental costs to fulfill the contract. So that's your subcontractors, that's your direct labors, or any machinery that you use, you will need to take into consideration, plus any other allocated expenses that's directly attributable to fulfilling the contracts. So think about it, if you have a project manager that's work on different projects, and when you're assessing your contract, if this loss making, you will need to include those allocated costs. So the bottom line is you may see a bit more contracts potentially moving into the loss-making territories after you adding into those allocated expenses. So if you do have some contract that's kind of borderline, you want to look into the standard to see if it's applicable to you or if you will need to make any provisions. So, all right, now we look at the amendment. That's one particular new standard I want to call out is about classifications of liabilities, whether you classify a liability as current or non-current. So the accounting standards say for an entity to classify a liability as non-current liability, the entity needs to have the right to defer settlement of the liability for at least 12 months at the reporting date. So let's dive into a little bit details about this particular requirement. So when we talk about right to defer settlement, so under the old standard, you actually need to have an unconditional right to defer the settlement. So the accounting standard, they do look at it and they think, okay, it's very difficult to achieve unconditional right? So in the new versions, they actually say your right, as long as it's substantive, you will then take that into considerations when you're assessing whether it's current or non-current. And also, if for you to be able to defer the right, you will have to comply with your loan covenant. So in the old standard, they were a little bit murky about this, but in the new standard, they say you must comply in your loan covenant at the reporting date. Even the testing of the loan covenant only happened after year end. So let's say you're preparing a set of accounts for June 2022, and your loan covenant typically only happened in September when you sign the financial statement. So you will still need to be compliant with whatever requirement happened in September. As of June, for you to be able to say, okay, I'm not breaching my loan covenant, therefore I'm classified this liability as a non-current liability. So the problem, the way you word the standard actually created some controversy here. It actually getting a lot of pushback from the companies and from the petitioners. So now they're currently changing some of the wording here. That's why if you look at my last sentence, this particular standard is going to be pushed out for another year. So the exposure draft has already come out. So that's a highly likelihood this particular standard is going to push out for another year. And so what's the takeaway here? Like if it's going to be only applicable in 1st January 2024, that's a few years down the road, why do we need to worry about it? The reason is a lot of time when someone enter into a loan agreement, it's going to be a long-term agreement, can be a 5-year. So by the time when this particular standard going to be effective, it will still affect all the outstanding liability, outstanding debt. So it might hit you in the future. So the takeaway point is if you are revisiting your loan agreement, if you are rolling forward your loan, don't just think everything as usual, business as usual. Take some of this requirement into consideration when you renegotiate your agreement. Okay, the next one is my favorite topic about disclosures. So there is a new accounting standard coming out to address disclosures about accounting policies. So remember the accounting policy, half set of accounts is accounting policy. Most of the time people will take a model set of financial statement and take out all the things that's applicable to the company and put it there. So now the requirement is actually to say you don't disclose all your significant accounting policy, you actually need to make a judgment. What is material accounting policy? And the standard does say what kind of accounting policy can be material. So things like if you have a choice, if you can do cost or fair value, or if it's to do with something very complicated, for example, revenue recognitions, you need to explain certain things to the user of the financial statement. You will then disclose those accounting policy. So it's all about decluttering your accounts, and it's all about telling a story to the user of the financial statement. So the standard is going to be effective first time for 1st January 2023. Early adoption is permitted if you're thinking to do something with your accounts, especially when companies moving to general purpose accounts. Do come to talk to us if you have any questions. So now I would like to hand over to Brent, who will give you the key asset focus for the reporting period.
Thank you, Jimmy, and good afternoon to those of you attending this afternoon. As Renee kindly mentioned earlier, I'll be spending some time going through last week's release by ASIC surrounding their key areas of focus for the 30 June reporting period that all entities, their directors and preparers should be paying closer attention to. ASIC highlighted 6 key areas, which are highlighted on the screen, being uncertainties and risk, asset values, provisions, subsequent events, disclosures, and other matters. I believe the ASIC Commissioner, Sean Hughes, highlighted it perfectly in their submission by commenting, many companies are facing challenging market conditions and uncertainties. Directors and preparers should assess the market on current and future performance, asset values and provisions. They should also ensure that increasing demands for better information for investors on uncertainties, key assumptions, business strategies and risks are met as required under the existing reporting regime for both annual and half-year reports. Going on from this, uncertainty and risk is the key theme across the 30 June reporting period, and understanding these uncertainties, the market conditions, and how this is going to impact your business. Whether these are factors like the continuing impacts from the COVID-19 pandemic, or they could be more industry specific, example being the potential pandemics such as lumpy skin in the agricultural sector. There could be uncertainty around future interest rate rises for those that are highly leveraged or have significant debt. Supply chain uncertainties around importation or inability to source materials for those that are in manufacturing. Workforce constraints for those that are in service or hospitality industries. Or even more broadly speaking, geopolitical risks with the engaging conflicts in Eastern Europe and how that will impact businesses on a more global economic scale. Understanding how these impact your assumptions and judgments when preparing your financial statements is crucial, and being able to disclose these for your users of the financial statements. So I guess more broadly speaking, or going into some more detail, arguably the most important of these key focus areas and likely to come under the most scrutiny from both ASIC and your respective auditors is asset values. And this is one area where each company will be affected differently due to their industry, location, supply chain, and just generally how volatile the market you operate in is. In particular, for those of you that have infinite life intangible assets, such as goodwill, you'll be required to test these for impairment under ASIC 136, using either a discounted cash flow model or a fair value model. For those who were joining us in our webinar, I think it was back in November of 2021, you'll have had the pleasure of watching me discuss on how to prepare a discounted cash flow model for the purpose of this impairment testing. I believe you can find this on our website. But I guess the key takeaways here when it comes to impairment testing is that impairment testing requires significant assumptions and judgments, including estimation uncertainty in areas such as discount rates and terminal growth rates, but also being able to adequately substantiate the forecasted cash flows reasonably, whilst taking into account the uncertainties and risks that I mentioned before into your forecasts, and how that's going to underlie the market conditions to build that recoverable amount to assess for impairment. And going on from that is that, as Jimmy mentioned, with the adoption of general purpose, these disclosure, the I guess the impairment testing requires the assumption and judgments to be disclosed in the financial statement so that users can understand and assess the process you've taken to justify asset values. Some of the other asset value areas and considerations that preparers and directors should be, I guess, considering over the reporting period around your property assets. If they're held at fair value, when was the most recent independent valuation taken? Are they adequate? Making sure there's no uncertainties in there. For those that aren't fair valued, looking at just broader conditions of those assets you're holding around vacancies on commercial or residential assets, and ensuring that, I guess, the cash flows being generated are substantiating that carrying value. For those that are in leasing contracts and have right of use assets, you're required to assess for impairment indicators, looking at making sure you're utilising that asset. Are they generating sufficient cash flows, and whereby it could be an onerous lease contract, it could result in impairment of that right of use asset. Your loans and trade receivables, often something that's overlooked a bit in my client base, and having ensure that you've prepared and looked at the expected credit loss models in line with ASIC 9, taking into account, I guess, those historic credit losses that you've seen over the past. But more crucially speaking, I guess, broadly in what ASIC's looking for is ensuring that you've taken into account the forward-looking indicators and aspects of the environment where there is those areas of uncertainty that I mentioned before, and where that could lead to increased credit risk or default risk in those debtors or receivables. And then there's a couple other asset classes there that I've mentioned around inventory, essentially ensuring that it's held at the law of cost and net realisable value, and with deferred taxes there, making sure that it's probable that you're actually going to be able to utilise those deferred taxes in the near future. But I guess the key takeaway is with each asset class, there are varying levels of judgment and uncertainty, and ASIC are looking to make sure that you understand this and how you're factoring into this to make sure you're validating your carrying values, and we're appropriately disclosing it in the financial statements. The next few areas I'm going to go into are a bit more straightforward and less complex than asset values, but they're just as important. The key areas that ASIC are looking into around surrounding provisions is ensuring that you've adequately identified, measured and recognised provisions that exist, and that your liabilities are complete. Some key examples of provisions that we would expect to see, or that you may just come across this reporting period, relate to lease transactions, like I mentioned before, but involving the make good provisions associated with these, restoration provisions for mine sites or other exploratory assets, restructuring or redundancy provisions, or even onerous contract provisions. I guess a topical example we've seen recently with onerous contracts where they may exist is in the construction industry, whereby a company may be contracted to build for a fixed price. However, due to the current economic conditions with suppliers, the prices keep on increasing. Now, this drive in building supply costs can drive the cost of construction past the expected earnings from this project. Now, given it's a fixed price, this could bring rise to an onerous contract requiring a provision, which I believe Jimmy went through in a bit more detail before around, I guess, the changes to that standard upcoming. But I guess the three key things to understand that if you have a provision or not is ensuring a present obligation exists due to a past event, that there's a probable economic outflow, and that it can be reliably estimated. Now, when a transaction or event occurs and you're in doubt, I always recommend using the recognition decision tree, which I've presented here on the screen, to assist whether you have a provision, a contingent liability, or nothing to worry about. More often than not, it's going to be one of the first two. Going on from this, we lead into subsequent events. Now, it's important to be thinking about subsequent events all the way up until the financials and statements are signed off, and to be keeping in mind the users of the financial statements at all times. What is important to them? What do they need or want to know? Now, when it comes to subsequent events, you're either got adjusting events or non-adjusting events, depending on whether the additional information about the event that existed pre-30 June. Now, if it did exist pre-30 June, you're following the green table up, leading towards the adjusting subsequent events. Now, I guess a couple of examples of what an adjusting subsequent event may look like could be the settlement of a lawsuit that happened before the balance sheet date. Now, I guess the interplay between subsequent events and provisions is that because it hadn't settled at year end, you would have been going down the path of a contingent liability and just disclosing that fact around a pending lawsuit. However, subsequent to year end, the lawsuit settled, you'd now be going back to that decision-making tree and it would become a provision, and therefore you'd be providing for that, for any of the actual losses, or conversely, receivables, or including adjusting events such as the realization of a loss in regards to the sale of inventory or assets held for sale when the subsequent sale confirms a previously existing unrecognized loss, i.e. the realizable value is less than your carrying amount. Now, if you don't have an adjusting subsequent event, you're then looking at just a disclosing subsequent event. And the key thing here is assessing, does it have a material impact on the user of the financial statements? And that really comes down to the users of your financial statements. But a couple of, I guess, the key disclosing subsequent events. Well, we've all seen companies having COVID-19 as a subsequent event in their financial statements and really detailing the impact on their business. You've also got when a company may acquire a new business, or if you're a 31 December reporter, particularly maybe in the retail space, you'll have seen the natural impacts of natural disasters such as the floods that happened in Queensland and New South Wales recently, and how that's impacted businesses subsequent to year end. And then finally, disclosures and other matters. Whilst this may not be as technical as the previous areas of focus, there is a significant importance on this around accurate disclosures, and it should not be underestimated. There is a need to ensure that the disclosures within the financial statements and throughout the other areas that aren't the underlying statements themselves are all relevant, topical to the industry and the specific company you're in, not just the blanket wording of what everyone else was putting in, and most importantly, not misleading to the users or investments in your financial statements. Now, the information throughout the report should also complement the information. It should be telling a story of how the entity's businesses have been impacted by that uncertainty, the risks that we've been discussing throughout, I guess, the past 10, 15 minutes, and the changing circumstances, as well as explaining to the investors and the users of the financial statement the drivers of the results and financial position, as well where the risks, management strategy, and future prospects lie. As you can see on the page, I guess I've highlighted a few key examples and considerations that should be made. I guess one of them that sticks out for me personally is the classification between current and non-current. Now, this could be most significant when you're looking at bank debt and considering if there have been any breaches in covenants. If there have been, this should be disclosed, whether you have or haven't, obviously, breached any loan covenants. And if you have, whether there's been any waivers or remedies sought out, as well as ensuring the classification is still appropriate post that effect. And it should be noted that a key mistake people often make is receiving a waiver from their financiers post year end and thinking they can still have the debt as non-current. Other areas of key consideration there around disclosing any assistance or reliance that a company may have had or continue to do so from the likes of governments, financier, even landlords, things that are really pertinent to, I guess, the ongoing running of the business. And even disclosure surrounding any non-compliance with laws and regulations. Whilst extreme, a good example of this could be material penalties for non-compliance with sanctions imposed in relation to trading with Russia. I guess the key message from ASIC is clear. It's around having topical, useful information that isn't misleading to the users or the investors. And on that note, I will hand you back to Renee to cover off any questions from throughout the webinar.
Thanks for that. We have received a few questions come through and we have a few minutes left and we'll do our best to answer some of these questions. But before we do, I do want to share the results of our poll with you today. Surprisingly, 52% of participants said appropriate disclosures in the financial statements is their key concern for 30 June 2022. 25% of you said removal of special purposes and 18% said valuation of assets will be their key focus area and only 5% said other will be their key concern. So I think we can quite accurately summarize that most people are worried about disclosures, removal of special purpose and valuation of assets this year. And that's pretty consistent with what we're seeing in practice. So it's good to see that our participants here today is very consistent with our expectations. So some of our questions that we got through the Q&A today, and if you have more questions, please feel free to submit them. Jimmy, do overheads apply to the assessment of loss-making contracts?
Yeah, thanks, Renee. That's a really good question. So I will say it depends. So if your overhead is directly attributable to fulfill the contract, so the overhead can be your depreciation of a machine, yes, you include those. But if your overhead is just typically administrative expenses, your stationery printing expenses, those you will not attribute to your assessment of the loss-making contract. So there is a level of judgment involved.
Right. Brent, what are some of the key struggles that companies might face in their asset impairment reviews this year?
I guess really it just comes down to an understanding of how to put together an impairment model and the methodology required under the accounting standards versus how someone might put together a discounted cash flow for the purposes of like M&A transactions and things like that, and just understanding those core concepts and differences, as well as even just being able to, I guess, break the business down into your core cash generating units rather than just looking at the business as a whole is a common mistake people will make.
I also think it seems to me that there's a bit more judgment or a bit more questions that we're getting on what is an appropriate discount rate in a environment where interest rates are going up, and where there might be more risk. So there seems to be a bit of judgment as well when people are doing their impairment reviews this year. And it does seem like a lot of companies are upping their discount rate, which is putting more of a pressure on asset values.
Yeah, great. I think a lot of people are looking at their discount rates and their risk premiums as it stands today and not actually adjusting that for, I guess, their forecast period, which is what you are trying to generate it over as well.
Right. We've had a question come through asking, when are we expecting the sustainability standards to become mandatory? First of all, I don't think they are going to become mandatory anytime soon. So we only have 2 standards for now that's been released in ED format. And it'll be interesting to see how widely companies will choose to apply them once they actually become final. And then over time, it'll also be interesting to see how they do, how and when and where and what kind of jurisdictions they do become mandatory. But there's no indication at present that they will become mandatory. Another question we've received here, Jimmy, I think this is for you. Will not-for-profit entities be required to prepare general purpose financial statements?
Oh, that's a really good question. So short answer is no. Like I do know most of the time I want to say it depends, but no, for not-for-profit entities, there is kind of a special requirement embedded in the accounting standard. If you look at those, they will start with AUS. So for not-for-profit entity, the reporting region is still not being finalized yet. So the short answer is you can still do your, if you're doing special purpose, you can continually do special purpose until in the future time when the not-for-profit project's finished. But if you are currently already on a reduced disclosure tier 2, and you are expect to move into simplified disclosure, which is not too much of a difference.
Great. Thanks, Jimmy. I think that's answered all the questions we've received today. So look, I just want to really thank everyone for joining us today. Thanks, Jimmy and Brent as well. Sorry about the situation with the sun that I've got right now. I must look very bright here. But it looks like we're out of time today. So that brings us to a close for our webinar. We'd love to hear from you. If you have any questions, any further questions we haven't addressed, please feel free to speak to your usual SW advisor or send through your inquiries to one of the speakers on the screen. Don't forget, we will send you the slides after the session. We'd also really value your feedback on the session, so please complete our feedback survey, which will pop up on your screen at the conclusion of the webinar. Our next session in our financial reporting update series for 2022 will be an update for the 31 December 2022 cycle, and that'll be on the 17th of November, and we hope to see you there. Thank you for joining us. Be well, stay healthy, and we'll see you soon.
Thank you.